So at this point, we talked about all the different types of financial statements, and you may wonder why they look the way they do and why we follow the rules that we do. And that's what we'll discuss right now. I didn't make up the rules that will give you misery throughout the semester. Instead, generally accepted accounting principles exist, which were created by the Financial Accounting Standards Board. So this is a group of people that get together and determine the rules that we need to follow in accounting in order to make the information useful for decision makers. The Financial Accounting Standards Board are basically the people that you can be angry with instead of me. I am only the messenger, my friends. I didn't make up the rules. The Financial Accounting Standards Board is out of Norwalk, Connecticut. And it's a board, a group of people that basically spend the day talking about accounting rules and concepts and come up with all the different rules that businesses need to follow. A little history on financial reporting, not that you really care, but it is kind of interesting to think that the foundations of accounting, most notably the stuff you're going to hate the most, debits and credits, which I promise, if you listen to me, won't be hard. It all started with an Italian monk and mathematician in 1494. So this whole idea of double entry record keeping, which we're going to learn about in future chapters, was all started by a monk. Who knew? And prior to 1933, the management teams of most companies basically chose their own financial reporting practices, did whatever they wanted, really. And the problem with that was that you couldn't really compare companies of different sizes. So that's when the Securities and Exchange Act of 1933 and 1934 came out, which created specific rules and principles that companies needed to follow in order to be traded on the stock exchange. So Congress created the Securities and Exchange Commission back in 1933 and 1934. They gave it broad powers to determine measurement rules for financial statements for publicly traded companies. It doesn't involve oversight of private companies. The SEC worked closely with the accounting profession to work out detailed rules that became known as GAAP, and it's the Financial Accounting Standards Board that's recognized as the body that formulates GAAP. And the official pronouncements of the FASB are called FASB Accounting Standards Codification, and those are basically the rules that all companies follow. Now, though the SEC only oversees publicly traded companies, private companies also follow GAAP, mostly because the users of those financial statements for private companies, most notably banks and other creditors, want the financial statements to be in conformity with GAAP because they need consistency among the financial statements for the different clients. Companies incur the cost of preparing the financial statements and bear the economic consequences of their publication. What does that mean? Well, when financial statement data comes out, it affects the selling price of the stock, it affects the amount of bonuses received by management and other employees, and there is some loss of competitive information to other companies, especially for publicly traded companies, because all the information in the financial statements is fair game for anyone, including the competition, to see. So when Congress determined that publicly traded companies needed to make this information available to anyone, they weighed the pros and cons and determined that the benefits of providing that information to the general masses outweighed any loss of competitive advantage. Sometimes we live in our own United States bubble, but it's important to understand there are other countries out there, and most other countries follow what's called international financial reporting standards, and those are issued by the International Accounting Standards Board. So the International Accounting Standards Board is like the international version of FASB, and IFRS is the international version of GAAP. Examples of jurisdictions requiring IFRS are included in the slide. You can read through those. In the U.S., the SEC requires U.S. companies to use GAAP, which are generally accepted accounting principles for the U.S. They're very similar to IFRS, but there are some differences. And the U.S. Does allow foreign companies whose stock is traded in the United States to use IFRS if they're foreign rather than a domestic company. Bottom line is the overall fundamentals, the basics of accounting are pretty much the same with GAAP and IFRS. It's the more complex issues where there is divergence between the rules. So what you learn in this class will be beneficial, even if you work on international financial statements under IFRS. The knowledge you get in this class will be applicable for the most case to those international statements as well. Ethics is extremely important in accounting. When I graduated, it was in 2002, and at that time, that's when a huge accounting scandal known as Enron took place. Enron was a large energy supplier, and their financial statements were fraudulent, and many people had relied on their financial statements to make decisions, and as a result of the fraud coming to light, thousands upon thousands of people lost their life savings, lost their retirement, and lost their jobs. In fact, my first job was at Arthur Andersen, and they were the auditor of Enron, and the entire audit firm, one of the big 5 international audit firms at the time, actually went out of business because of this scandal. So the point is, ethics is extremely important in accounting. So we need to be able to identify the benefits of a decision, figure out any alternative courses of action, and then choose the one that we'd like our family or friends to see reported on the local news. In other words, we want to do the ethical course of action. I suppose this choose the one that your family and friends would like to see on the local news really depends on how reliable your family and friends are. But in any case, we need to consider more than just making profit. Like, certainly it would be profitable to dump toxic waste into a river rather than treat it properly, but that would not be ethical. So we need to consider more than the bottom line in making our decisions. And if we don't, there are ramifications. Here are some examples of some defendants from very high stakes fraud situations. So the financial statements of Le Natures was misleading, and now the various defendants from upper level management are serving a significant amount of time in prison. So it really doesn't pay. You need to think long term, not short term gains. So though movies like Wolf of Wall Street may be exciting to watch, following in those paths are not the best choice if you would like to stay out of prison. We can't rely on management to always make the ethical decision, so we need some type of internal controls to protect the company, both their assets and financial records. So one thing the company does is have a system of controls over records and assets, like locking up money in safes, having video surveillance, security guards, having rules in place to make sure not one person has too much authority over the financial statement numbers. We also hire independent auditors. That's what I used to do for a living, which is having people come in from outside the business to double check all of the numbers and make sure that they're being recorded properly and in accordance with GAAP. The external part is extremely important because that ensures the auditor is independent of the company. They can't have any ownership interest or other relationships with the company. And then there's also a committee on the board of directors to review the internal controls and oversee the auditors to make sure that the company is doing what they need to do in order to succeed and in order to mitigate the risk of errors and fraud in the financial statements. We'll end our Chapter 1 discussion with two of the supplements in the chapter. Yes, I said supplements. My God, you got to read the whole chapter and some supplements. And the first is Supplement A, which deals with the types of business entities. There's three basic types of business entities: sole proprietorships, which are owned by a single individual; a partnership, which is owned by two or more; and a corporation, which is ownership is represented by shares of stock that can be bought and sold by owners. So that's what most publicly traded companies are set up as, corporations, and then they can sell stock to various owners on the stock exchange. The focus of this class is going to be on corporations. You've probably been involved in a sole proprietorship or partnership without even knowing it. If you ever babysat or mowed lawns, you probably had a sole proprietorship. If you did it with a friend, it was a partnership. The downside of those types of business entities is there's absolutely no limit to your liability if anything goes wrong. So a corporation has several advantages. That is why most companies are set up as corporations. And we'll go over those advantages or disadvantages in a second. But for your futures, when you first start out a small company, you don't necessarily want to set it up as a corporation. Instead, you might want to consider setting it up as an LLC, which stands for Limited Liability Company. And basically, you get a lot of the benefits of a corporation without the downsides. With a limited liability company, you're limiting your liability to your investment in the business, so they can't go after your personal assets if something goes wrong. But at the same time, you don't have the double taxation that corporations do, which we'll talk about now. Corporations allow, number one, limited liability. So if I'm an investor in Disney and some catastrophic event happens at Disney, Space Mountain collapses or something, and Disney gets sued and they lose everything in the lawsuits, my loss is limited to my investment in Disney stock, not my personal assets, my house, my car, etc. Also, when I die, Disney will continue. Even if I'm an owner and I die, well, Disney's dead, and yet Disney continues. So corporations provide continuity of life in the business. It's also very easy to transfer ownership. If I want to sell my ownership in Disney, I can just do so on the stock market, can buy and sell shares very easily. And because of that, it's also much easier to raise larger sums of money by selling shares to a large number of people. So we don't have to get all the money from one owner. We can do an IPO, which is an initial public offering in the stock exchange, and get a whole bunch of money from a whole lot of people all at once. The primary disadvantage to a corporation is double taxation. Basically, that means that the corporation pays income taxes, and then when they distribute dividends, you may remember we discussed those before, to the owners pay tax on those dividends. So the corporation pays tax on the profit, then after the profit, the taxes are paid, they give dividends to the owners who pay tax on that same money again. So that is the downside of a corporation, that double taxation. Again, when you start out your little business someday, start it out as a limited liability company, you'll get this limited liability benefit without that double taxation. Then when it gets bigger and bigger and grows and becomes an IPO, an initial public offering, you'll probably convert it to a corporation at that point. I mentioned in the very first video of the chapter all the various career opportunities in accounting. Public accounting is the most common career opportunity that our students take. It involves working for multiple different companies. So you work for an audit firm and they have multiple clients. And then you do audit and assurance services, which lends credibility to the financials because you're independent. You can also do consulting and advisory services and tax services. The great thing about public accounting is you're working with different clients in different industries each and every day. So it never gets dull. It never gets old. And you can get paid a good amount of money. Usually people don't last very long in public accounting because it is a lot of hours, but because you're exposed to all those different clients, a lot of times the client hires you, pays you more, and you work less hours. So most people leave public accounting and go into the private sector. I left public accounting and went into education, so I didn't make more money. But I do love my job, and though I'm not a huge fan of online, because I'd much rather be in front of you in person, hopefully you'll see my dedication throughout the semester and understand why I chose this path. We can also go and be employed by organizations doing their internal accounting, helping with the external reporting that is going to be provided to the public accountants, tax planning, and other various functions inside the business. And then there's a lot of employment in the public and nonprofit sector. So if you want to save the world, you can join a nonprofit in their accounting department. Government agencies need accounting information, like the SEC, the Government Accountability Office, and the FCC. All use accountants. What I like to remind students, because they probably think accounting is dull, is the number one recruited major for the FBI is accounting. You got to follow the money to catch the crooks. So there's all sorts of different opportunities that you can get from an accounting degree. It's not boring sitting and debiting and crediting things all day. Oh, we'll be doing that, don't you worry. That'll come in the future, but that isn't what you do day to day in the real world. You have to understand those fundamentals, but you're not going to be doing it on a day-to-day basis. You're going to be making much more interesting decisions. There's also various professional designations. CPA stands for Certified Public Accountant. I have that designation. CMA is Certified Management Accountant. CIA is Certified Internal Auditor. One that isn't on here that I have is CFE, Certified Fraud Examiner. So I'm a Certified Fraud Examiner and I'm a Certified Public Accountant. Those are my certifications, which you get by working and getting experience, as well as taking a very difficult test. The CPA more so than the CFE. And that concludes our discussions for everything in Chapter 1. Remember, to be successful, you have to practice, 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 and then when you can't take it anymore, practice a little bit more.